Thank you, Sheldon. If you can hear me, just shake your head. Just everything's good. Okay, good. This is actually my third interaction with USC in the last 8 years. It's the first one virtual, but I'm thrilled to be here. I will say it's about the most challenging time to talk about the market and economy I can remember since I got in the business. I actually believe we are in the most unique set of economic circumstances that I've seen in my career, and certainly in the post-war period. I believe policymakers are failing to acknowledge how unique this period is, and I think the consequences of that could be with us for years, if not decades to come. Now, why do I say the period is so unique? Well, first of all, the COVID-induced decline that we experienced last spring was both violent and abrupt. To put it into math terms, we had 5 times the decline in the average recession in 25% of the time. Think about that. So 5 times the average World War II recession decline in 25% of the time. Monetary and fiscal policy's response to that was equally unprecedented. It's not pleasant to remember back last spring, but if you think about that period, I think we were all terrified that we were experiencing a potential black hole, not only in our lives, but in the economy itself, with potentially catastrophic consequences. If you look at the policy response, it was extremely aggressive. Led by the CARES Act, in 3 months, we increased the government deficit more than the last 5 recessions combined. So if you took the Reagan 82 recession, the Saddam Hussein 90 recession, the dot-com recession, the great financial crisis, you added up all those recession's effect on our budget and the size of the budget deficit combined, they do not equal how much the budget deficit increased in 3 months last spring. The Fed response was equally aggressive and unprecedented. They did more QE in 6 weeks last spring than they did in the entire period from 2009 to 2018, which you'll remember was somewhat unprecedented in and of itself, and a lot of people were questioning the size of that. Well, the peak month during that 9-year period was when Bernanke did 85 billion in QE. We're still buying 120 billion in securities after the 6 weeks that I talked about. The final thing that happened last spring was the Fed crossed a lot of red lines in terms of what they would backstop in terms of corporate debt, also in the municipal market. The results were very emphatic. Corporations increased their debt in a recession. I don't believe it's ever happened before, over $1 trillion in response to the Fed backstopping that debt. Just to put that into perspective, in the great financial crisis, they shrunk their balance sheets 500 billion, which is much more, I'd say, consistent with historical activity. The good news is this has resulted, I'd say, pleasantly, surprisingly, in a very abrupt and strong recovery. In that context, it was a good risk reward to enact policy expecting a deep and protracted recession in the spring of 2020. It worked, it was dynamic, it was bold. However, a lot has changed since then. By the fall, the outlook had already brightened considerably, and policy support continues to accelerate. Fiscal deficits are going to reach 30% of GDP in just under 2 years. Okay. I'm going to share a screen with you. This is a chart of the cumulative fiscal deficit from the start of the recession of all the recessions that I mentioned earlier since 1980. And you'll see the top 4 lines are the 4 recessions that preceded this one. I'm sorry, the 5 recessions that preceded this one. And the black line is if you added up all those together. Remarkably, the red line is what we're doing in 2020 and 21. Again, the boldness of what they did and the beginning of that chart, when you say the first 5 or 6 or 7 months, makes a lot of sense. But what's very surprising is we're continuing to double down on these policies, even after it's quite apparent you've had a very strong recovery in the economy. The Fed's easy money will also top a similar amount, almost 2 times all previous Fed incursions into money printing. Now, what we have observed in recent months is the sharpest recovery from any downturn in recent history. Despite losing 11 million net jobs during 2020, personal income grew at the fastest rate it has grown in 20 years. Think about that. While 11 million people were losing their jobs in a year, we ended the year with the strongest growth in personal income in 20 years. The unemployment rate has recovered 70% of the initial hit in just 6 months. It typically takes 25 months for this to happen. Even after the sharp fall, again, 5 times the average recession, we're already back in terms of GDP to pre-COVID levels in just 5 quarters. The average recession takes 7 quarters, but don't forget, we're coming back from a much deeper hole that was 5 times as deep as that observed in the average recession. It is unnecessary and frankly reckless that 575 billion of the 850 billion in direct transfers of 2.5 trillion of expected QE are being provided after retail sales were above pre-COVID trends and after vaccine confirmation. So if you look at the red line on the chart I have up, that is 2020. I think we can all agree it doesn't look anything like the other recessions, which are more traditional in nature. Much more violent increase in unemployment, and then a huge snapback in a much shorter period of time. I think even moderate voices will agree that the level of support has been excessive. Let me show you how excessive it actually has been. This is a chart of retail sales the last 20 years. They are currently above pre-COVID trend by 15%. Look at the period from 2008 to 2014. It took 6 years to get retail sales back on trend after the great financial crisis. But if you look at the current period, we had a sharp V bottom out, and I mentioned the CARES Act. That's check 1. Then we had more fiscal stimulus last fall after vaccines were apparent and after it was apparent that we were in a very unusual recovery. And now, as you know, we've just passed another $1.5 trillion of stimulus when retail sales are 15% above trend. What does that mean exactly? If you took the increase in retail sales from 2016 to 2020 on this chart, that's 3% a year in a recovery. We've just done that in 6 months. We are absolutely booming. We are above trend by, frankly, 5 years in 6 months. Okay. Now we have, let's talk about the Fed's excessive support. The Fed has constantly reminded us that monetary policy acts with long and variable lags. Why then is the Fed still providing emergency financial conditions when the recovery, as I've shown, is in full acceleration? Why are we buying $40 billion of mortgages a month when we are clearly running out of housing supply? Not only is the Fed still providing record amounts of accommodation, it is promising not to raise rates until after 2023, even when the recession is already over. If the Fed raised rates in the first quarter of 2024, as indicated, it will be 41 months after recovering 70% of the drawdown in unemployment. That was the chart I showed with the red line earlier. What do you think the average number of months before the Fed's first hike after a 70% employment recovery is in the post-war period? So it's 41 months that Chairman Powell is predicting. What do you think the average after that kind of recovery has been since World War II? 4 months, 4. And according to the chair, they are not even thinking about ending $120 billion a month of bond purchases. Simply put, the fastest and strongest recovery from any post-war recession is being met with the Fed's easiest response on record, by a mile. Policymakers say we need to go big to avoid downside risks and avoid the stagnation experienced after the great financial crisis. But as I have shown, comparisons with the great financial crisis are completely inappropriate. What about the risks of financial stability? The worst economic periods of the last century have followed the bursting of asset bubbles. Think the 30s after the 29 bubble burst, and think about the great financial crisis after the housing bubble burst. With Dogecoin, which was started as a joke, with a $60 billion market cap and NFTs on everything you can spell out there, is there any doubt in anybody's mind that we're in a bubble? Not to mention stock market to GDP is well above any level that we've seen in the past century. More ominously, what about the risk of fiscal dominance and loss of our reserve currency status? All right, let's see if I can do this without help this time. This is a chart of foreign purchase of US bonds. Frankly, US treasuries have been the go-to assets for global portfolio managers for the better part of 20 years. They've particularly been attracted to them as a safe haven in so-called risk-off periods. Look at the period surrounding the great financial crisis. Look at all the green above the line. Something stunning happened last March. In the middle of the equity meltdown, foreigners aggressively sold treasuries as we proposed the CARES Act. So I'll never forget it. Right in the middle of the worst part of the equity meltdown in the third week of March, there was an 18-point decline in the bond market. We didn't know what it was at the time, but we found out months later through Fed accounts that foreigners had sold $1 trillion worth of bonds in response to the CARES Act. Again, this has never happened before, but they are watching our behavior, most of which I've outlined in the last 5 or 10 minutes, and they're frankly saying no mas. Asians and others have been purchasing Chinese assets who have done no QE and much less fiscal stimulus in response to COVID, and they're doing just fine, thank you very much. With China representing 20% of world GDP and only 1.6% of global portfolios, and the US representing 25% of GDP, but 28% of world portfolios. Remember, China 1.6%. This process is probably early rather than late. And the last thing the US needs is interest rate burdens. As the last few administrations have refused to mitigate the growth in entitlements, knowing that we were entering a great boom as baby boomers turned 65, debt to GDP was already set to cross 100% in the next decade. I mentioned earlier I'd been to USC before. Back in 2013, it was part of my college tour to outline the problem of the gray boom. Basically, since the Great Society, various programs have increased entitlements per person in the United States dramatically. What I was worried about back in 2013 is guys like me and Sheldon that were born a few years after World War II were all about to turn 65, and there was a lot of us. It was called the baby boom, and it was about to turn into a gray boom. The problem is Social Security and Medicare were on a pay-as-you-go system, and as we were about to receive all these benefits, there was less workers available to provide it. That was the problem I outlined back then. We are now throwing $6 trillion of extra spending into the pot just as the gray boom accelerates. Ironically, one of the answers I would give when I was inevitably asked what to do about the problem, I said we should raise the age of Medicare. People are living longer, people are healthier. The Biden administration is requesting to lower the age of Medicare to 60, creating a $400 billion hole in the name of infrastructure. I mean, seriously, you can't make it up. All of this spending has been encouraged by the Fed and aided and vetted by QE and low rates to finance it. There is no way bond yields would not have gone up without the Fed financing all the things that I've been showing the last 5 or 10 minutes. But look at this chart. The CBO projects that the new debt level, despite drastic cuts in the growth of non-entitlement spending, that's the gray line, will result in interest expense of 27% per year if the 10-year rate was to normalize to 4.9%. Simply put, the system cannot handle it, so the Fed will be forced to monetize it. Think about that, 27% of GDP just in interest costs alone. That's basically all the money we've spent in COVID relief in the last 12 months. Like many post-war periods, this will inevitably lead to inflation and financial repression by central banks, despite not having had to finance a major war. I believe we have crossed the Rubicon, and this is the only solution for this unnecessary and self-inflicted situation from this radical monetary and fiscal policy I've outlined. Currently, 85% of the world's transactions are done in dollars. I think we have crossed the Rubicon, as I said, and for the first time in my career, I believe we will lose this reserve currency status and all the benefits that come with it within 15 years. I've never said this before, I've never even thought it before. At present, there is no alternative because of the lack of the trust in the communist dictatorship in China and the mess that Europe currently is. I don't know who's going to replace us, but my best guess is the biggest threat is a crypto-derived ledger system that will be invented by a group from an army of engineers leaving universities, like USC. I will conclude my remarks with how my family office is positioned given this backdrop. This comes with a huge word of caution. For those who know of me, my intermediate view is very flexible, and I do change my mind. I see I've used up my 20 minutes. Let me just say that for obvious reasons, we are positioning ourselves short the dollar. I think you'll understand that from what I presented in the presentation. One might ask, in terms of shorting the dollar, why did the dollar not go down when foreigners started selling bonds last March and have continued to sell them through today? So as opposed to 500 billion in bonds flowing into the United States a year, they're now flowing out. The answer is it happened in COVID. And as you all know, and I think some of the earlier speakers alluded to it, the students, COVID was extremely beneficial for companies that serve the digital economy. It just so happened that the FANG stocks and many US companies like Zoom were better positioned to deal with COVID than any of our finer counterparts. So we had a huge inflow into the equity market here that made up for the change in the bond flow. Once valuations got high, that dissipated and the dollar peaked out in July. We've recently had a bounce that I think is unsustainable. That bounces, frankly, because US growth outlook has picked up relative to others because of our vaccine rollout. But as soon as the vaccine rollout catches up in Europe and Asia, which I don't think will be far behind, I think the downtrend in the dollar will resume. We are short global fixed income. The booming economy I've outlined. I just think 1.6% on 10 years is ridiculous price, particularly relative to history. They've historically traded right on top of nominal GDP, which is running at 10%. I'm not predicting that, as I said earlier, we'll never get there. The other way we positioned ourselves for this inflationary outcome is we're long all sorts of commodities. We've been long oil, we've been long copper, we've been long the grains. Pretty much if it moves, we're long it in the commodity world. And finally, equities, we are long, but I will be very surprised if we don't make the exit by the end of this year. I was lucky enough to just start Duquesne as Ronald Reagan entered with Paul Volcker running the Fed. And as you know, many commentaries, everyone pretty much agrees that the combination of Jerome Powell and the Biden administration is an unraveling and the exact opposite of what Reagan and Volcker did. And I don't really see how the S&P, I think, was 780 at the time, or the Dow was 780. We've gone up 5, 10, 15, 20 fold since then. If Reagan and Volcker were so bullish, I don't think what we're doing now in terms of regulation, taxation, is sustainable. And I will remind those, if you invested when Ronald Reagan was elected, because of Volcker, you lost a lot of money the first 18 months. So they did not take a myopic view and the dividends paid 20 years. I think today we're very much in the opposite situation. I've overstayed my welcome in terms of time, and I'm happy to answer any questions.